Hello, friends. This video will be very useful, as it will save you from many of your own mistakes, will save you from losing money. Here will be wisdom, the quintessence of both my personal 20 years of experience in investing, and the experience of many other people, my friends, including very successful and wealthy ones. That is, all the information voiced has been tested in practice and there will be no empty theoretical speculations, only useful practical information. Well, maybe a little, just a little, I will add philosophical thoughts, as always on this channel. This will make the information even more valuable for you. Friends, I immediately voice all possible disclaimers that are only possible in a video on such a topic. There are not and will not be any individual investment recommendations. Any investment is inevitably associated with possible losses and I, of course, as the author of this channel, am not responsible for your personal decisions and your actions. Smart people will be able to extract a lot of useful information from my thoughts, from this long video, but those who need specifics, what stocks to invest in, what specific securities to buy, should not be upset. After all, what interests you is, in fact, secondary. Frankly speaking, it does not matter at all what securities to invest in for the long term. What is important are general long-term trends and the ability to get rich, to increase your capital. In the applied aspect, to become rich, it is much more important to understand general narratives, some features of human psychology, thoughts that you will hear in this video. This is more important than information about what paper to buy and what specific asset to bet on now. Thus, investment analysts, gurus and forecasters will not make you rich, you can do it only yourself, thanks to the knowledge of the basics of thrift and the basics of financial literacy. So, I will begin my story. Where to begin? So many thoughts, so much information I want to convey to you. I will begin, perhaps, as strange as it may seem, with some criticism of the FIRE movement, that is, the movement of early retirement. Why are people disappointed in this concept, the concept of living with capital at an early age? After all, it is so wonderful to retire, go into cash, into money, selling your business, doing only what brings you pleasure. One of the not-so-obvious answers to the question why is it unprofitable sounds something like this: because people make cognitive errors in understanding what capital is in general. What is the essence of the concept of capital? Most people understand this word only as money, only financial assets, that is, how much money resources you have in your account from which you can regularly extract 4% and live without working, on a conditional pension. But capital is not only money. It is also qualification. It is knowledge, skills, abilities, these are available resources. And resources can be completely different: time, health, these are also our resources. For example, a young 20-year-old guy has plenty of health, plenty of free time, but he has no cash, no money. Any rich person, a billionaire, in old age would gladly exchange all his material wealth for the health of this young guy if it were possible to do so. A cool businessman sometimes does not even have time to communicate with loved ones, he does not have time to call his mother. But this is a very valuable resource. And part of a person's total capital. In this conditional formula, capital is the product of money by qualification and resources. That is, in the conditional equation, capital is equal to money multiplied by qualification and by resources. Any of these factors, if it becomes equal to zero, can zero out our total capital. And each of the variables is important, not just material assets. Each of you watching this video has some area, niche, sphere of activity in which you are better than all other people. For example, I am a professional doctor, a scientist, I am engaged in diagnostics and treatment of diseases in humans. Some of you listening to this video are engineers, lawyers, or programmers. Someone is a great plumber or builder. Someone is the best at fishing and understands gear, bait and so on. Someone can solder radio components better than others, that is, a radio amateur. And all this knowledge, skills and abilities together determine your qualifications. Returning to the early retirement movement. Why would you, at the conditional age of 35, so early, voluntarily give up a significant part of your capital. This is complete stupidity, the stupidest thing that could be done. For example, you had a successful business or a successful career, a position, you earned some money, and then suddenly sold the business, quickly quit your job, and are retiring early at 35 to 40 years old. When you are at the peak of your professional capabilities, when the share of capital, including qualifications, is maximum. In this way, you have accelerated your disqualification in the specific area that allowed you to earn the money you have for retirement. That is, in the area in which you feel like a fish in water. It is as if you took and voluntarily burned part of your capital, leaving only a smaller part of it, only money that you still have to learn to invest. Your competencies and qualifications in the profession will most likely only fade with age anyway. You will lose qualifications for objective reasons, younger, more nimble competitors will appear, competition will increase over the years. And in the case of following the FIRE movement, this process is also voluntarily accelerated by you. This, in my opinion, is one of the weak points in the idea of simply sitting on a mountain of accumulated money and living off capital. Do you seriously think that you will be able to immediately understand the intricacies and nuances of the financial market, in investments? Do you think that you will be as successful in this as in your main qualification? You have been studying for years, decades, accumulating this part of the capital, and now you want to just go and instantly trample years of your life, start all over again in a completely new field for you. It is good if you succeed in the financial markets. But practice shows that most people do not succeed, and they rather start losing their capital than preserving it. If you already have competencies in the field, for example, of the restaurant business, and someone in the field of computer technology, and suddenly a computer specialist suddenly wants to go into the restaurant business and open his own cafe, he will most likely make all the possible mistakes that could be made at first. Most likely, he will lose money, will not be able to immediately become successful in a new field for himself. And vice versa. Because capital is not only money. Capital is also competencies, qualifications, skills and connections. The financial market, the world of investments, is arranged in such a way that if someone wins, then someone is sure to lose. Stocks fall. And just think about it. You, having no experience, voluntarily begin to compete with the sharks of the financial market, with those who literally learned this from childhood. And you, for example, are a cook, you know how to cook superbly, professionally, or a doctor who knows how to treat people. But in order for us to learn how to earn, for example, on the stock market, it is worth devoting a lot of time and effort to this, knowing some inside information, learning how to analyze company reports. And even this will not 100% protect you from crises on the stock market, from black swans in investments. Without inside information, without some exclusive secret information, you will not be able to earn money on the stock market for a long time and stably. And why should you risk and invest all your money in a field in which you do not understand anything yet? Even if some success awaits you when investing in shares, it will rather be a pleasant coincidence, when for several years or decades, for example, the stock market has been constantly growing, the quotes of all securities have been growing. You hit the nail on the head. In a period when all stock indices are growing, everything is green, all people are earning, but believe me, no one knows the future. This trend can quickly change and you will lose. In other words, I consider it stupidity, a rash act, when you think and decide, should I go into early retirement at 35, selling my successful business, in which I have high competencies? Quit a good position, go into cash and invest all the money in something that you do not understand at all, do not have insider information. Unless you are a relative of the CEO of the enterprise in which you are going to invest your money. Yes, I agree, if you are the wife of the CEO of some large enterprise, joint stock company, and you know for sure how things are really going in this business, what it breathes, then God Himself ordered you to play on the rise and fall of shares of this issuer. That is, to buy and participate in this business. But most often this is not the case at all. And the understanding of all followers of the FIRE movement, the early retirement movement, often comes down not to understanding the concept, but to simply going into cash, into the monetary part of capital, zeroing out the other two variables in the capital equation, namely, qualifications and resources. An attempt to save this cash after selling your business by investing in other people's businesses, if you do not understand the intricacies as well, can end unsuccessfully. This understanding of early retirement is a kind of downshifting, stupidity. And when building a career, at the beginning of any business, you do not have the monetary part of capital, and all your efforts are directed at developing qualifications, resources, connections, that is, the most valuable part of capital. You will not have free money at the start, at the beginning of running a business. A young person will not have money, he only has his competencies, strength, energy, which can then be transformed into monetary resources if desired. But this will not happen right away. Don't get me wrong, but the idea of going into cash at some point is not bad. Only if you are going to manage this money using your qualifications and using the skills you already have. Or the field of money management is close to you. Answering the question of whether it is worth investing in the stock market, buying shares, bonds, IOUs, my answer is, it is. But on condition that your qualifications allow you to do this. If you have something that other participants in this market do not have. Reliable information, knowledge unknown to others. Otherwise, you will most likely only lose money. If you already have a good working business that consistently brings you income or a stable career with a good salary, then why lose it voluntarily? Why get rid of a cash cow that regularly brings you milk? Thus, our capital is not only money, as many people simply believe. The most valuable assets are your professional knowledge, experience, your established connections, for example, your notebook. Your acquaintances with useful people. All this, unfortunately, can also become outdated. With age, we all do not become healthier and do not become much smarter. Not everyone will be lucky, like Warren Buffett at the age of 94, to maintain a clear mind, a good memory. I am sometimes asked, what exactly should I invest in? How to form my portfolio so that in old age I have a good passive income and do not need money? Therefore, the correct answer will be, something as simple and stupid as possible. Like yourself. Because in old age, you will most likely have already lost most of your qualifications, you will have a bad memory and poor health. In fact, you will be an old sick grandfather or grandmother, most often with mild encephalopathy. And most people actually need something as simple, as understandable as possible, albeit with a lower yield, but stable, conservative. Surprisingly, it may turn out that a regular purchase of residential real estate, a simple one-room apartment in the city where you are going to meet your old age, this will be the best investment idea. Despite all the diversity and complexity of other instruments. Do not forget that you will be stupid, with dementia. Now look from the outside at your grandparents. And think about what financial advice you could give them, what they should have invested in 50 years ago. What did they need to invest in back then to at least preserve their capital today? It is not about multiplying, friends. It is only about transferring capital to your future. The only goal of investing, what I always talk about, is to direct at least 10% of each income to investments. This is the minimum hygiene level, like brushing your teeth and washing your face every day. You simply cannot go below this level, it is not serious. Those who spend everything or even more, regardless of the size of their earnings, still remain poor people. I have repeatedly reminded about this in my old videos on this channel. For example, in the video called Why It Is Important to Be Frugal. There are many important thoughts there. How is stinginess different from frugality? Do you need money to be happy? Or another video, Why It Is Important to Look Poor, Financial Success Through the Prism of Consumption. In this video, I literally show on my fingers, provide calculations, how each of you, if desired, could become a dollar millionaire. In a word, a treasure trove of useful thoughts that have already taken into account my personal experience and the experience of many other people. Believe me, friends, I have had many years of experience investing in securities through brokers. I will not say that it was negative, but, as often happens, it was not without losses. Thank you, I understood everything. The experience was very valuable for me, but expensive. But still, I am grateful for this experience and some mistakes. And today I am sharing with you the most valuable and intimate, what will save you millions of bumps and save you a huge amount of your own money. Well, friends, as they say, let him who listens hear. Note that I am not discouraging you from investing in securities. I still believe that this is a wonderful tool, useful. But in skilled hands and with the right qualifications, with the ability to know and foresee what other people do not yet know. Bonds, like all sorts of mutual investment funds, are essentially an IOU, a promise from some guy to return your money on time. Guys can be different. Some return, fulfill their obligations, allow you to receive income. But at all times and under all systems, people have broken promises, are breaking them and will continue to break them. Living people and nothing human is alien to them. Remember this, even the most reliable issuer may not fulfill its promises. In order to diversify the investment portfolio, if you are going to accumulate promises from uncles, it is better to have different uncles. Save up promises from different people, this is the only way to spread the risks thinly. If someone does not fulfill their obligations, the losses will at least be minimal and the blow to capital will not be fatal. I am not even talking about some fraudulent schemes, financial pyramids, and so on. You should always keep one simple thought in mind, the risk/return ratio. The higher the return, the higher the risk, as a rule. And vice versa, the lower the return, the lower the risk of losing capital. This is a universal rule, it is suitable for any investment instruments. It is important to evaluate the risk/return ratio. This is why relatively safe investments cannot, by definition, have too high a return. This is an axiom. And this is why I will allow myself to assert that the main goal of an investor is not to increase capital, but to preserve it. That is, protection from inflation. If the return is slightly higher than inflation, great, wonderful. But do not strive for this. At the expense of safety, do not be tempted by high returns. In an attempt to get an excessively high return, you run a great risk of being left behind in this conditional race. The wisest proverb says, the slower you go, the further you will get. Playing the long game does not imply high returns, and all the examples that will be given to you that someone made a lot on trading, or invested everything in some stock, or received a lot from investing in cryptocurrency, or in something else. Yes, someone was temporarily lucky, but this does not give any guarantee that you will be lucky. I really liked one statement, a paradox. Someone said, the stock exchange is a very strange place, one sells, the other buys, and both simultaneously believe that they are right. No one knows for sure how these or those quotes will behave. Consider it a game of the lottery. God forbid you get involved in speculative games on the stock exchange, in the forex market for example, in trading, where you, unqualified investors, will almost 100% only lose money. Always remember about this proportion, risk/return. Has anyone taken a big risk? Well, for God's sake, do not envy such people. Envy is a destructive feeling that only brings suffering. There was also interesting and useful material on the channel about this, a video called Why Does It Seem That Everyone Around Has More Money, That Everyone Is More Successful, Richer. It reveals interesting psychological mechanisms of envy. So, money in itself does not have a defining value in human life. This is an important philosophical thought that many investors, and ordinary people simply do not understand, ignore, do not realize. We earn money to spend it. Perhaps, not today, it will happen tomorrow or in 10 years. But reasonable, rational consumption, financial literacy is precisely about learning to manage this resource. What is an investment? It is the transfer of money from today to yourself, but only into the future. All psychologists usually start to protest. Oh. The syndrome of deferred life, these are mentally unhealthy attitudes for a person. Let them be indignant, but they are poor. And they cannot back up their statements with scientific data either. Just as they cannot refute the fact that if you want to become a wealthy, rich person, you will inevitably have to learn to transfer capital to your future, learn to beat inflation. Well, there is no other way. This is an inevitable need in the life of a modern person. Money is not the meaning of life, money is not an absolute value, but it is also difficult to live without it in the conditions of the capitalist world. Money gives a certain degree of freedom. In the video called Why Does Everyone Seem to Have More Money?, I reveal a very important idea, trying to derive a golden formula for the consumption rate. Namely, I am talking about the principle of proportionality of spending and money saved. Rationality and proportionality are put at the forefront by rational people. And this does not actually contradict what psychologists say. There is no risk of falling into the trap of postponed life if the principle of proportionality is strictly observed. What is a healthy consumption rate? If your salary, your monthly today is, for example, $3,000 per month and you spend all these $3,000, then you are just a fool. You simply do not think about your future, do not live in harmony and in accordance with the realities of the modern world. But by the way, if you earn 10 times more than $30,000 a month, and spend only $300, that is, you enter a complete savings mode, then you are also a fool, because you do not get enough from life, you voluntarily constrain yourself with very narrow limits, boundaries of consumption. As soon as this begins to bring discomfort to yourself, to others, as soon as you begin to turn into an unhealthy person, a miser. The criterion of mental illness does not lie in the norm of consumption, but rather in the criteria of adaptation disorder. Like any psychiatric diagnosis, it is made only in the presence of social maladjustment. I am telling you this for sure, as a doctor. The golden criterion for making any diagnosis in psychiatry, in addition to clinical manifestations, is the factor of social maladjustment. If people turn away from a person, a husband or wife leaves, a person is fired from work, only then do they usually seek help from a psychiatrist. Only then can a diagnosis be made, for example, schizophrenia or manic depressive psychosis, or any other serious diagnosis. As long as there are no signs of social maladjustment, dear psychologists and psychiatrists, any supporter of the FIRE movement with a saving rate of 80 to 90% is officially a mentally absolutely healthy person. And you have no right to hang labels, condemn people, express your own poorly proven theories. If a patient sees hallucinations or déjà vu and at the same time he is respected at work, everyone appreciates and loves him, if he has a wonderful family, children, and such a person has no problems communicating with other people, then this, is the norm. If such a high savings rate does not prevent a person and those around them from living, it does not manifest itself as social maladjustment of a person, then this is normal, even despite the presence of oddities and some symptoms. What is mental norm in general? Average norms of behavior, conditional frameworks accepted in a particular society. Okay, let's not delve into psychiatry and psychology now. I will immediately outline my position, to each his own. I do not have a strict recipe for how to achieve happiness. How to properly organize your life, save or spend. It's like comparing white with wet. To each his own. Happiness is such an individual phenomenon that one person feels it when saving, and another only when spending. There are no assessments and unambiguous judgments about what is good and what is bad. The main thing you should understand if you have accepted the concept of early retirement is that this is a philosophical concept that provides for some borderline behavior that can be misinterpreted by others. It is important to choose a like-minded person as your life partner, a person who will share your views on life and values. By the way, about how to do this, how to find the love of your life, what criterion you should focus on when looking for such a close person, how to choose your social circle, friends, there is a very interesting and useful video on the channel, which is called, how to recognize a decent person. Okay, I've gotten distracted from the main topic, the topic of investments, capital formation. So, a very important thought, money is important, but it is not the meaning of human life, it is not the most valuable part of your capital in the broad sense of this concept. Capital as a combination of qualifications and resources. Moreover, money is the worst thing you could drag into the future with you, because you will have to constantly worry about money, think about it not being eaten by inflation, diversify it across different currencies, choose only reliable banks, and so on. Money is the worst part of capital, and it is a mistake, in my opinion, to focus only on money, on investing it. Those who focus exclusively on saving money, but forget to pump up other components of their capital qualifications, knowledge, skills, usually do not achieve great success. Their capital, of course, grows, but in real terms it is much less than those who do not focus only on money. Once such a very interesting experiment was conducted. In one of the universities in the USA during economics classes, the teacher gave all the students $10 and told them to try to increase this amount in a month, without limiting them in the rules. Then the students had to make a report on how they acted, what they did to earn more, to increase the starting amount given. There were students who immediately thought that it was possible to earn on interest from these $10 and lent this amount to friends for a month at interest, but the amount was so small that they received a miserable income, not even dollars, but some cents, because the term was very short, only 1 month. Many students tried to create some mini businesses, for example, having bought several lemons for $10, having made lemonade, they tried to sell this lemonade on their campus. These earned much more by the end of the month, some $15, someone managed to double and receive $20 to $30. And this was already a good result, to think like a businessman, not like an investor. But the best result, paradoxically, was obtained only by those students who completely abstracted themselves from these $10 in their pocket or bought some tools necessary for their business with them. These students bought notebooks, pens, and began to do what they are good at, that is, mathematics, and what they had already done many times before, in which they already had developed qualifications. They essentially began to engage in private tutoring. And a month later, this group of students could boast not $20 instead of the initially issued $10, but several $1,000s, and some students, tens of thousands of dollars. Why am I telling you this? Because the most effective strategy was to simply forget about this small amount and develop in what you already have competencies in, already have qualifications. The easiest way, if you have the knowledge and skills that you have already developed earlier, is to convert them into real money, and not get hung up on multiplying, adding a few percent to the original amount. Therefore, when they ask how to invest a not very large amount of money, for example, $1,000. How to invest 1,000 or even 10,000? The correct answer is, you just need to forget about them. As if they do not exist at all. Just forget or buy with this money what is necessary for development in the direction in which you have talent, have a desire to develop or already have accumulated over the years of knowledge, skills. And for this, in turn, you need to understand what you have such abilities for. What can you do a little better than others? And such professional orientation, unfortunately, also becomes a rather difficult task in the life of many people. There are many examples when people only by the age of 35 to 40 understood what they really should do, what their talents are and the maximum benefit to society. I repeat, capital can only be obtained by creating some benefits for society, bringing benefit to people. No other way. And to preserve capital, to transfer it to yourself in the future, to protect against inflation, there are different, including simple, understandable to everyone, tools. And the stupider you are, the simpler these tools should be. Starting from simple deposits, reliable bonds, preferably government bonds rather than corporate bonds, since the probability of government default is much lower than that of individual companies, precious metals for a small part of the portfolio, real estate with subsequent lease. The instrument should be understandable to you personally, and the sources of income obvious. I will not spend hours talking about diversification now. I am sure that many have already heard about this, do not keep all your eggs in one basket, diversify ideally across different asset classes. But I will repeat once again, if your goal is retirement, then keep in mind, in old age you will be dumb, you will be stupid, most likely with dementia, and it will be difficult for you to manage your capital parked in some risky or volatile instruments. Personally, I really like such a simple asset class as residential real estate and long-term lease. Specifically residential, not commercial, which on the one hand has a higher yield, but essentially requires entrepreneurial activity, more activity. Like short-term rental of residential real estate, that is, renting it out for a day, all this is a kind of business that will require a lot of energy and strength from you, and you will not have so much of it in your old age. You ask, where to buy real estate? The answer, where you plan to meet your old age or actually use the capital, live from it. It is not worth it, living, for example, in Spain, to buy real estate in the USA or Hawaii. And vice versa. Firstly, it is far to fly, inconvenient to manage. You do not know the local laws, taxation methods, and so on. It will be difficult for you to move in and evict tenants, and outsourcing all this, delegating, this greatly reduces the rental yield and carries many unexpected risks. Accordingly, this reduces the attractiveness of such investments. If you plan to live in the USA, then please, buy in the USA. But if you live, for example, in Paris, France, or in a small town, in Germany or Italy, then buy only there. Where you plan to live, it is better to choose a property for rent. The fact is that the income from renting residential real estate usually provides about 1/2-1/3 of the average salary in the region, in the city where you rent this property. That is, even if you live in a poor country, for example, in Nigeria, for example, and renting a residential property brings you an income of only $100 per month in local money, this is very little, then for some reason with this amount in the city, in the country where you live, you can live at least half a month. The lower the income of the population, the poorer the country, the cheaper the real estate there and the cheaper the goods and services there. Therefore, choose the city and region where you are going to live yourself, where you know everything and where it is easy to manage the property. Some investment consultants may criticize this approach. They say that rental rates are low, residential property can also fall in price and such investments can lose to other types of assets. And I agree, yes, in the short term, a year or two, especially in a strong currency, property may decrease in price a little. But in the long term 10, 15, 20 years real estate as an asset only grows, or at least has an upward trend. If in some year it does not recoup the amount of inflation, then in the next year it will definitely exceed the yield by 2 times, and as a result, on average, over long periods of time, housing, real estate, especially if the location is chosen correctly, behaves like an ordinary durable product. A product that does not have a long service life and practically does not spoil. I will explain it practically on my fingers. Ideally, if it were possible, the best investment would be to buy rice, flour, sugar, meat, fish for future use. But this is impossible, these goods are perishable, they will definitely spoil. Therefore, the best long-term product at all times is real estate. That is, you have a room made of stone and metal, which in itself is a product, physical protection from inflation. And in addition to inflation, you get a small delta, a percentage, income from renting out the property. Usually, bad analysts who criticize real estate investments take into account and demonstrate nominal income. Like, why should I buy and rent out an apartment if I can buy securities or put it on deposit and get twice as much nominal interest on my account? And many stupid people believe such arguments, because nominal figures are worth believing. But one important point is not taken into account. In the case of a deposit or a promissory note, we are dealing with nominal yield, income on printed paper. And it is not a fact that a deposit will always beat inflation. There were times when debt instruments lost to inflation. And in the case of an apartment, in addition to inflation, you get some additional bonus in the form of rental yield. It is wrong to compare this bonus with the nominal yield in any debt instruments that have not yet lost inflation. Any debt instrument is a promise from some guy, and any promises of living people, as we know, have always been broken, are being broken, and will continue to be broken. But an apartment can also burn down. It requires depreciation, repairs, a war, or an apocalypse can start. All this is true. Of course, I will not argue, any investment has its risks. But if you analyze the risk/profit ratio, then residential real estate in any country in the world is one of the best investment tools. It was, is and always will be. Sometimes Mark Twain is quoted in this regard, who said, "Buy land, they don't produce it anymore." This resource is limited and will always be valuable. The next important thesis is typical for rental yield, for any tools with regular additional income payment. Consider the investment object as a hypothetical cow. The cow gives you a bucket or two of milk every day and you should be absolutely indifferent to how much it currently costs on the market. These are still virtual numbers. Even if it costs 3 cents or $30 million, it makes no difference to you, you will always have a bucket of milk. The average salary in your city will become low, real estate and rental rates will become cheaper, but in such a scenario, prices will most likely fall, since there will be no demand and you will still receive about half of the average salary for renting this particular apartment from the tenant. You will be able to buy yourself at least bread, basic products, clothes. You will never go hungry if you have residential investment real estate. Even in the case of the most apocalyptic scenarios, real estate will never depreciate to zero, unlike promissory notes and other derivatives, the so-called non-commodity instruments. There is a very important idea that many do not understand and do not realize. There is a one-time income, and there is another option, cash flow. Some use the word passive flow, but I would not use such a word as passive at all in relation to investments. There is no such thing as completely passive income. Any type of investment requires some activity, including brain activity. There are no 100% passive investments. Even a simple deposit is not a 100% passive investment. You need to go to the bank on foot, sometimes wait in line, sometimes for several hours, open an account, open a deposit, and replenish it. And even if you do all this remotely, on your smartphone, you also need to have minimal competencies, be able to replenish, constantly monitor more favorable interest rates, reinvest and replenish the deposit. Plus, it is always worth monitoring that the bank does not close and you do not lose money, rebalance money between different accounts and banks. I'm not even talking about brokerage accounts and investments in securities. You need to constantly monitor the company's quarterly reports, monitor its condition. It is necessary to constantly monitor that intermediaries' brokers fulfill their obligations. There is nothing 100% passive, it requires at least moral strength, mental and other costs. I'm not even talking about renting out real estate. The process of finding tenants, ongoing repairs to the property, monitoring the timely payment of utilities. This is only on paper, the share of a rentier seems carefree and easy. In fact, many people find it easier to work a quiet day in the office than to rent out real estate to someone under a lease agreement, taking on a million associated small and large risks. Just as there is no easy money in principle, there are no 100% passive investment instruments. Friends, in this video I tried not to take any positions, not to impose my opinion on you, but at the same time I expressed some very useful thoughts that will be useful to many. There will be skeptics who will say, and all these investments are complete nonsense. Like, live for today and don't think, come what may. And they, perhaps, will also be right in their own way. As I already mentioned in the old video called What is the Meaning of Life, the meanings of life are constantly changing for us. And in general, everything in life flows and everything changes. Today, while you are young and full of energy, you have one meaning, life. Tomorrow you will grow old and your priorities may also change. If tomorrow the doctors tell you that they have diagnosed you with, for example, a malignant tumor of the 3rd or 4th stage, that you have approximately 3 years left to live, you must admit that your attitude to investments and to life in general will change greatly over these 2 to 3 years. Just as there is no single meaning of life for everyone, there is no single investment strategy that is universal and uniform for everyone. Some people like risk and drive, financial pyramids, options, risky instruments on the stock market, some more conservative instruments, precious metals or real estate, but the main idea, it seems to me, is what I wanted to convey to you today. There has been some expansion of your understanding of the concept of capital and capitalism in general. So that you do not waste time, do not try to multiply the small amounts that you have available, but try to increase your capital due to its most valuable part, qualifications and already available competencies. Thank you for your attention and see you soon.